that it really becomes clear, and Hurricane Katrina was just like that. In Katrina, we had an entire city that was completely depopulated, flooded up to the rooftops, businesses gone, homeowners distributed to the other 49 states, and really a challenge trying to figure out how does a city come back. Well, in this case, we're working with a region of the state, and the complexity of the topography and the road systems and the bridges and all that really make this different and more complex than Katrina even was. We have issues like insurance and access to building supplies and labor and all of the things, and then just working through the red tape of the government can be very challenging. I'm encouraged by what Governor Stein has already done with his executive orders, the individuals that he's brought in to advise us on the recovery. And so we'll be in the middle of that, helping inform that process, and the banks will be right in the middle of that. I called Gary shortly after the storm. I had driven out to western North Carolina and driven the region, and I've met with bankers, and I've worked with bankers in their branches just to see it and experience it myself. And I called him on the way back, and I said, I don't want to make the mistake here that I made in Katrina. When I was there for Katrina, I was focused like a laser beam on banking. Let's get bankers back up and running so they can provide basic banking services to the city of New Orleans and the people as they begin to come back. That's all. That's what I did, and I focused on it. That's not going to work here. What we need to do here is collaborate among the other industry associations, the chamber, the home builders, the railroads, and the realtors. I could go on and on. We need to be communicating with each other and supporting the work of the state government as they work with the federal government to bring resources to bear in the region. And then to understand what our individual industries can do. There are more than 50 banks doing business with 335 branches in the federally declared disaster area. What that means is the risk to the banking industry has been widely distributed across a number of banks. So there are no banks in trouble. Everyone has profitability, capital, liquidity, and resources to bring to help the small business owners and the homeowners who need it. So we'll be there. The person who will be advising the governor on this process went through Hurricane Katrina with me back that many years ago, and he's been working. His name is Jonathan Krebs. He's been working with city governments and state governments and municipalities to work with the federal government through disasters since Katrina, and he's bringing to us all the experience, all the mistakes made, all the lessons learned to help us do this the right way. He also knows the people to contact, the buttons to push at the federal level. So I'm encouraged about that. But no one wants to hear this, but our greatest need is for patience. We're going to need to be patient. We're going to have to work hard and be focused, but it's going to require some patience, unfortunately. Katrina took close to a decade to bring New Orleans back, and I don't know if that's how long it will take in western North Carolina, but we need to be ready for a long slog, unfortunately.
Peter, I'd like for you to brag a little bit.
Okay.
Peter and the North Carolina Bankers Association, and I don't want to steal your thunder, if you could tell about the fundraising that you...
The day after the storm, and we realized we were getting calls from bankers and we were doing our outreach, we learned that what had happened. We stood up, our board met the following Monday and set up a hurricane relief fund for bank employees who had lost their homes or suffered significant loss of personal property, cars, personal belongings, things like that. We had an application process that we put in place because we had gone through this with Hurricane Florence. So it was our second rodeo with this process. And we put out an appeal to bankers to contribute. And bankers across the country, both individual bankers, board members, banks, bankers associations from across the country, the American Bankers Association, the Independent Community Bankers of America, and even one of my banks back in Baton Rouge, Louisiana, First National Bankers Bank put up $100,000. We collected close to $500,000, and we've distributed that to more than 230 bankers, bank employees, many of them lost their entire homes, they've lost cars, they've lost belongings, significant property damage, and in small increments in terms of the distributions that we were able to make. But our thought was, think of it when you're on the airline, on an airplane, and the flight attendant tells you to take your mask in the event of an emergency, take your mask, put yours on, and then help your neighbor. We needed to help bankers sort their personal issues out so that they could get to work helping their community and helping their customers. And there are countless stories I could tell of how they did exactly that in the devastation that they were personally experiencing. So it's a small thing we were able to do, but I'm very grateful for all the generous support that our industry has given us and that others have. Thank you.
So we have 900 people sitting in the audience here today, and you've just heard these stories about this particular area of Western North Carolina, and we need you to help us and help these 16 different associations. We need you to communicate with the policymakers to let them know that this area of the state requires more attention. We also want to encourage you to travel up to that area to buy goods and services. And also, you can buy goods and services that are online and get them shipped to your home. So you don't actually have to travel up there. But that will really help those communities up in Western North Carolina if everyone, all the business leaders in the room here, understand that that's actually impacting the economic vitality of our state. So they need your support, and we're here to encourage you to support this area of the state. So thank you all. All right, we want to shift gears here just for a minute, and we want to talk about small businesses. And I think you're all aware that small businesses are really the backbone of the economy. They're the job creators. And the number one problem that every small business will raise their hand and say is access to capital. And so, Peter, you have created a site in conjunction working with the Small Business Development Technical Center and also the North Carolina Chamber. So why don't you tell us a little bit about that site?
Well, thank you, Jim. When Jim Sills was chairman of the North Carolina Bankers Association, he came to our board with some big ideas. And he challenged us to do some big things. And one of them was to focus on access to capital for small businesses. And small businesses of all kinds across the entire state. And we looked at different ways we could do that. And one of the challenges a small business has is when they have a need for capital, what's the first thing many do? They go to the Google machine. You know, they type, loan or something, or whatever they need. They'll type it in and get results. And so our thought was create a central portal, a website that any small business owner can go in, and based on their location, their profile, they can find a lender, a bank, or a CDFI that fits their need based on who they are, what they do, and where they're located. And so we went to the Small Business Technology Development Center, the Chamber, and the North Carolina Rural Center, and asked for support in this initiative. And so the four of us collaborated on this and then launched the website. The NCBA hosts the site, and we maintain it. And you can go on there, any of you, if you'd like, capitalopportunitiesnc.com, and look up lenders. And the beauty of this is many times if a small business owner is in need of capital, they'll get out, they'll go Google, or they'll look up phone numbers of a lender and just call an 800 number or call a local branch. What this website does is this takes you to a designated person that the bank has decided is the point of contact. This is who a small business owner should call to get navigated within the institution based on their need and what they do. And so this is just one thing that we're doing. We're focused on many other things, but we're very proud of this website. And Gary, thanks to you and Patrick Woody and Byron Hicks, who's not able to be with us today, for your collaboration on this.
Thank you. Is the website up on the screen, or?
I think so.
Okay,
We
great.
can't see the screen.
We can't see the
though,
screen, so
yeah.
it's up
Give
there.
us a thumbs up.
Very
Okay.
good, very good.
Okay.
Well, we're 2 weeks into 2025. We have just experienced a very interesting election cycle. We want change. We want the policymakers to know that we want what we want. We just got to do a better job of communicating that. And that's why all of you are here today, because we need your help to help communicate that. So I would like Gary to tell us kind of some of the policy objectives that he's looking to push in this coming year at the state level. And then I'd like Peter to talk about some of the initiatives that he's pushing or like to highlight at the federal level. So Gary, we'll turn it over to you.
Yeah, thanks, Jim. And first, a little bit about small business, and really appreciate the collaboration that we had with the bankers, SBTDC and Rural Center, to help get access to capital. Right after access to capital, and closely aligned, is access to health insurance for our small businesses. We hear it, we have a local chamber federation we're in contact with. We hear it through our colleagues in the banking industry and other industries about the importance of small business. No matter what industry it is, there's a 2, 3, 4, 5 multiplier of jobs that come from larger companies that have an indirect impact and create smaller business jobs in communities all across North Carolina. So we've been talking about it, we've been educating, building relationships for the better part of 10 years with our insurance community, our small businesses, our legislature, to be able to do something that hadn't been done in North Carolina in a long time. And towards the end of last year, we were successful in getting the ability to aggregate small business lives across industry segments for employers with 2 to 50 employees. The segment that has the least opportunity and least ability now has most difficulty finding insurance for themselves and for their employees. So a big priority for us this year is we were able to get the policy passed. So the chamber, working with local chambers, came to an understanding, an agreement, and a collaboration with the House and the Senate, Department of Insurance, and we worked closely with Blue Cross and Blue Shield, and we're going to start a health plan for small business this year in 2020. Well, hopefully everything goes well, and it'll be open for open enrollment for 2026. So we're going to spend this year getting that in place, where 2 to 50 employees will be able to come together. If they're a member of the local chamber, they become a member of the North Carolina Chamber. If the local chamber isn't participating, which we hope they all will, and have that availability to be able to provide something that small business hasn't had in North Carolina in a very, very long time. A small business health plan that is being regulated by the Department of Insurance going forward. And what's the key to that? It's the key to working with people who've done it before. So Peter Gwaltney will be sitting on the board of that health trust for us to help guide us through that, because the bankers have done it before and have done a nice job with it. We'll be working with insurance agents and Blue Cross, and we'll be working with the Farm Bureau and others, including Natalie English with the Wilmington Chamber will be sitting on that board to build this. So stay tuned. There's more to come. Our first trust meeting is coming up February the 6th. And after that, you'll be able to hear and learn a lot more about it going forward. On the agenda side,
Hold on. I'm sorry.
yeah.
Peter has a very similar model at the North Carolina Bankers Association, and we just like Peter to maybe highlight the model, how it works, why it's important.
Thank you, Jim. And this is something I'm excited about, even though it's at the chamber, and it's why I've lent myself to serve on the board. The North Carolina Bankers Association has had such an arrangement since 1990. It was a huge lift. It's called a Multiple Employer Welfare Arrangement, MEWA. We started our MEWA in 1990, and since then, the average rate increase for our member banks has been right at 5% on average over that period of time. You can imagine the stability and the cost savings that that brings to our members that are businesses just like the members of the NC Chamber. And so how it's managed and all that's involved, it's highly regulated. Any experience we can bring to the Chamber's effort, we want to do, because that's good for business here in North Carolina. It's good for small businesses. And it's going to be a huge lift. And I'm grateful to the Chamber for the willingness to take this on. And we'll be doing everything we can to help.
Thank you, Peter. Hey, Gary, we're going to go back to you in terms of what are some of your legislative priorities that you think we all should be aware of?
Yeah, thank you. They fall into three buckets, or our three pillars that going forward. The first is, when you look at workforce and education and talent supply, we are fortunate in this state in that we have jobs, but we have more jobs than we have people. Part of it's a birth rate thing, right? The birth rates are less than what they were before, and we're growing out of the hard work that's many in this room and others have done over the last 10 or 15 years to help this be the best state in the country to create a private sector job for people to have a good job. Two things, and you heard about one of them, that are a key part of the existing workforce and will be a key part to attracting the talent we need here, are going to be housing, which we talked about and pleased to partner with the realtors on. You hear more about that. And the other is childcare. The availability of affordable, accessible childcare for families in North Carolina, two-parent household families, single-parent household families, families that either both have to work or choose to work. We have to look at childcare differently than we had in the past and be able to work closely in collaboration with our companies, with our government, and look at public-private partnerships as a way to describe that piece. And I think and some regulatory reform needs to occur. Things have changed, and we need to modernize that, keep our kids safe, make sure there's a good environment for them, but at the same token, make more of it available. It's a key workforce enabling issue. Housing and childcare are two of the key issues in both of our studies that we see are really key to keeping us competitive. So it's really important there. On the infrastructure side, it's about water and energy. And we're engaging, our North Carolina Chamber Foundation this year is engaging in a study, a stakeholder engagement to look at water and wastewater and how we look at how we plan for and how we invest in water and wastewater management across the state of North Carolina. And there's going to be some opportunity there to collaborate, looking at public-private partnerships, looking at regionalization where it makes sense, and talking about what we learned from Helene out west. Look at what the eastern part of the state has been learning and experiencing and teaching us. How do we build that continuity and resilience? And I was just at an event last night with the Dutch consulate. And what can we learn from places like the Netherlands who have managed to do this? So stay tuned. We're engaging that. We'll be doing that water study. And the other is energy. And North Carolina, one of our competitive advantages historically has been reliable, affordable, accessible energy. We're a growing state. Businesses are coming. People are coming. The demands on energy are here. And they're only going to grow. So for us, it's about how do we get from where we are to advanced nuclear energy, where we can begin to lead the country in making that available. So that's about a bridge and an all-and-above energy strategy that bridges to advanced nuclear, and how do we get natural gas into the state, more of it, to make that bridge so that we can have new partnerships in the energy sector for the large manufacturers, the medium manufacturers, all of us that use energy, for the data centers that are coming to this state. They're coming because we have a good business climate. They're coming because we have good talent. Energy is essential to making all of that work. And then the last piece, in early February, we were very privileged, the North Carolina Chamber Foundation, to partner with Golden Leaf and the Farm Bureau to develop a strategic plan for the state's largest industry, agriculture. So we will be announcing a plan early in February that has been a year long in the making, and through multiple stakeholder events on agriculture. And they have engaged everybody along that side, everybody in agribusiness that they could get to a meeting,
over the last year. And there'll be a bunch of things coming from that'll be about how do we keep North Carolina not only feeding North Carolinians in the region, but we feed the world out of North Carolina. And also, we know a generation is turning over in agriculture, and there's not as many folks coming up, so we have land to look at. We have labor to look at. So stay tuned. We'll be advocating for some of those this year, but that's a longer-term project. I think the thing, Jim, is that when our annual agenda comes out every year, you're going to see that these are installments on a longer-term plan. So we're on top right now, and to stay on top, we got to make decisions that not only we may see some of it, but we may never see it. But those strategic investments in our workforce, in our education and talent supply systems, and in our infrastructure are going to be essential. So those are the topic areas, and we'll be taking good bites out of those going into 2025.
Peter, we have a number of bankers in the room, so we would love to hear your thoughts on some of the policy initiatives at the federal level that you are pushing.
Very good, thank you. Most bank policy comes from the federal level. Congress passes laws, and state laws are also in effect, but to avoid a crazy quilt for interstate commerce, it's important for banking law to be mostly directed at the federal level, and then for the regulatory agencies, which are also at the federal level, to collaborate with our state regulators. Katie Boskin from our Office of Commissioner of Banks is here, does a wonderful job in terms of supervising our state-chartered banks. We will be focused on right-sizing some of the regulatory structure that's been put into place over the past 4 years. Our legislative agenda is very measured. It would appear to not be too ambitious because we have to be realistic of what President Trump is going to be able to do in Congress and how that would affect banking. Most of our work really needs to be done at the regulatory level within the agencies. And the phrase that was coined during the Reagan administration is personnel is policy. And so the heads of the regulatory agencies, the Federal Reserve, in terms of bank supervision at the Federal Reserve, the Office of the Comptroller of the Currency, the regulator of national banks, and the chair of the FDIC, all insured banks, the heads of those agencies will have a big impact on our industry, which will have a big impact on the economy as a whole. And over the past 4 years, I've been doing this for 35, and I've seen more new regulation, significant, meaningful regulation put on the banking industry than I've seen in my career. The velocity of it has been staggering, and it's more than a lot of bankers, they would confess to you, it's more than they can comprehend and take in and prepare for compliance. And not a lot of it is meaningful in terms of consumer compliance or safety and soundness, the kinds of things that you all really care about. And so we're going to be working to right-size that, to get back to a posture where we can fuel the economy and be the engine of economic growth that the banking industry is. So that's what we'll be focused on for the most part in the coming year.
Peter, tell me the number one thing that you think the bankers in the room could do more of to support you and the North Carolina Bankers Association. You know that's one of my favorite topics.
Advocacy. Thank you, Jim. Advocacy. I was telling someone earlier, some of my bankers I was talking to earlier, you must be present to win. If you're not in the room, if you're not at the table, good things just don't fall in your lap. You have to show up. You must be present to win. And we're very present. And so if I could have one late Christmas wish, it would just be more engagement, more presence. And some of our bankers do an amazing job. We go to Washington, D.C. on a number of times a year. We're going to have a banker day at the General Assembly this year, and I'd just like for everybody to show up and talk about the good things banks do.
Thank you. Let's close with some final thoughts. I'm going to share mine as well. I appreciate your respective organizations' taglines. The North Carolina Chamber a force for business, NCBA, strong banks, strong communities. What's your vision for the year through the lens of your respective taglines? And we're going to start with Gary.
I think for us, there's an incredible opportunity that we have to do a bit of a reset and for the business community and our policymakers to have that equal seat at the table for the betterment of North Carolina, to reset the relationship just a touch and talk about how we kind of put the election behind us and we say, here are the top priorities and we're going to make a difference this year, and that be a mantra. It's been hard. It's been, for the last few years, been difficult, a lot of difficult elections, a lot of stuff going on back and forth, and they're over. And let's maintain the relationship, put the relationship first, and advocate and do some courageous things for North Carolina. It's time. We've worked really hard to get here. So for us, it's going to be about what are those courageous things that we can do that we need to do again. For the long-term betterment in North Carolina, we have an opportunity to reset a little bit. The election's over. We can't use that as, well, let's wait till the election's over. It's game on because people are coming. We have a great opportunity here. We're on top of our game in North Carolina, and the best time to change your game is when you're on top, right? And we're on top, so making those hard decisions now will be key. So our focus is going to be courage, and it's going to be about initiative. And it's going to be about being direct and having those really important conversations to keep things moving forward. And the last thing is it's never let anybody forget about what's going on in Western North Carolina. It's 25% of our state. It's an important part. We're all one state. So we're committed in 2025 and beyond to making sure people don't forget what we have to do there so our state can prosper.
Our vision statement, I'm still working. I don't know. I've conserved battery during this time. So our vision statement, a vision statement is an aspirational statement of where you want to be or who you want to be or where you want to go. Ours is strong banks, strong communities. We believe if at the NCBA, everything we do is focused on building strong banks. And that's done through advocacy. It's done through professional development programs that we host and sponsor. It's done through our health insurance trust so banks can have more affordable insurance, so they can save money and spend it elsewhere. All the different things we do, everything we do is focused on building strong banks. We'll have strong communities, and we'll all be better off for it. You know what happens in a community when a PTA or a nonprofit or any group of people get together and they need to raise money for something, they say, who can we call? They list the banks first. We need to call our bankers, and they always meet the challenge. They step up and do that. They can only do that if they're profitable, if they're well capitalized, if they're strong. And so the regulatory issues that I talked about earlier, that's to make them stronger. Any legislative issues we work on, whether it's pro-growth policies, fair competition issues, it's all about making them stronger so they can benefit their communities and build strong communities. I went into banking early in my career because I wanted to help people. And if you ask our bankers around the room, they'll probably tell you the same thing, that shared sentiment. But they've got to be profitable, and they've got to be strong, well capitalized, and liquid to do that. So that's where our focus will be. That vision keeps us focused. Thank you.
Thank you, Peter. I've been with M&F Bank for 10 years. Our tagline is empowering growth. And our focus is making sure that local communities have the economic resources to do what they need to do. We've just recently passed the $500 million or $500 million asset threshold. We want to continue to expand in North Carolina in 2025. But our focus is really on small and medium-sized businesses to give them the capital, but also the other financial resources for them to prosper and be successful. And I know that all of us working together as bankers and also in the industry, one of our goals is to help get North Carolina back our #1 status as the #1 state for business and we can all work together to do that. And that's one of our charges at our institution. Even though our institution's small, that's something that we're focused on. So with that, we've had a great panel. I really appreciate the opportunity to participate as the moderator today with you, Gary and Peter. And I just want to congratulate Gary on the health benefit plan for small business. They've been working on that for how many years? At least 10 years. They're finally getting off the ground. It's going to be a huge benefit for small and medium-sized businesses. And Peter, I appreciate everything you're doing in the banking industry at the state level, but also at the national level. So this has been great. Thank you again. And I wish everybody a happy new year and a prosperous 2025. So thank you all. Give them a round of applause.
Thank you. Appreciate it. Thank you.
Thank you, Peter, Gary, and Jim. Appreciate your leadership. Good afternoon, everyone. My name is Laura Bunn, and I serve as treasurer of the North Carolina Chamber and as the Mid-Atlantic Regional President for First Horizon Bank. It's great to be here with you today, and we are excited to have economic experts here to talk about how North Carolina remains competitive on the national and global stage. Our speakers today will take questions if time allows, and you can submit those on your phone by scanning the QR code on the slide and in your program. So I'd like to welcome our speakers, our panels, to the stage. Please note that their bios are in your program. So first, Travis Clark, U.S. economist with Visa. John Connaughton, director of UNC Charlotte Economic Forecast. And Laura Ulrich, regional economist and senior manager of the Federal Reserve Bank of Richmond, Charlotte branch. So thank you guys so much for joining us today.
Here we are. These are uncomfortable. Hi, everyone. It's great to see all of you back here again this year. I'm Steve Daniels from ABC 11 Eyewitness News, and I always love this event every year because I get back in this room and I see so many of my friends who I've met over the past 25 years here. People we've raised our kids together, kids went to school together, sports teams together, and so many of you I've met at other great events across the area year after year. And I'm reminded it's all possible where we are as a region right now, where we are as a state, this dynamic place where people want to come, they want to grow their businesses, they want to move, they want to stay because of all of you and your leadership. Your business leadership, the political leaders we have here, it's because of you that we live in such an exciting place here in the Triangle and in North Carolina. This conversation I love every year because it's a roadmap for where we're going. It's a look ahead to the year ahead. And we have some great minds here. My friend Laura Ulrich is here. Laura is, as you've seen in her bio, she is lives here in North Carolina, and she's an economist with the Federal Reserve Bank of Richmond. She has great insight. I always try to, in my conversations on ABC 11 with Laura, I always try to pin her down on what's Jay Powell saying in the back halls of the Fed? What is the FOMC really thinking about interest rates? We'll see if I can pin Laura down today. I have varying luck with that, so we'll see how that goes. John Connaughton is an economist at UNC Charlotte. He produces a really great forecast for where we are in North Carolina, where the economy is, and we'll dive into that. And Travis Clark is an economist with Visa. Travis has just flown in from San Francisco to join us here today, and he can really dive into consumer spending, consumer habits. Where is the mind of the American consumer right now? So, again, if you'd like to present some questions to us, we'd love to take those, but this conversation moves very quickly, so I'm excited to kick it off. Laura, let's begin with you. What I love about Laura is she doesn't look at data to arrive at her conclusions. Laura travels the state of North Carolina. She's talking to business leaders. She's talking to business owners. She's really a boots-on-the-ground economist. And Laura, I always love your real-time view of where we are. So as we're beginning the year, what's your take on the economy for where we are now and the year ahead? We can, let's see if, you have a mic pack on? Okay, there we go.
That's
Okay,
working.
perfect.
Okay, so because I work for the Fed, I get to remind you guys that what I say up here are my views and not Jerome Powell's or
Yes.
Tom Barkin's or
Yes.
anybody else at the Federal Reserve. So we have a team of economists that travel. Are at the Charlotte branch. We cover North and South Carolina, so we travel across both states. I also do work on higher education policy and research at the Richmond Fed, so I also have the opportunity to travel to the other states in our district, which includes West Virginia, Maryland, and Virginia as well. So I spend a lot of time in all 5 states. And throughout the whole time I've been at the Fed, since I joined in 2019, the Carolinas have really outperformed the rest of our district in terms of economic growth in any way you look at it. So if you look at GDP growth or employment growth or however you look at it. So that continues to be the case. That being said, I always find it important to remind people that about half of the 100 counties are not growing. So the growth is not evenly distributed across the state, right? The growth is in the Triangle. The growth is in the Charlotte market. It is in Wilmington. It has been in Western North Carolina, parts of Western North Carolina. So there are parts of North Carolina and South Carolina that continue to lose employment and population, and so those counties struggle. But there's nothing that we're seeing in those conversations that we're having across the state to show that the patterns are changing very much. I will say that the uncertainty that we're facing, and I know we'll talk about that as we sit up here today, the uncertainty that we face because of the election, because of other things going on, because of Hurricane Helene and other kind of world events, is making some companies kind of slow down their decision-making processes. So we aren't seeing, for example, we're not talking to a lot of companies that are laying off workers, but we are talking to companies that are saying, we're not hiring at the same pace we were a year or 2 years ago. And really, from an inflation standpoint, that's not necessarily the worst thing in the world, because we needed the economy to slow down a bit to get inflation back to the Federal Reserve's 2% target. So far this year, we're kind of expecting more of the same. And really, since in a post-COVID world, we've had strong economic growth. Over the last 4 years, the United States, it's been very strong. And in places like North and South Carolina, it's been even stronger.
John, let's get to you, and let's get right to it. Your forecast for the year ahead for North Carolina's economy.
I want to comment on what Laura said about North Carolina doing better typically than the nation, and that's certainly been the case for a number of years, and certainly 2024 started out that way. However, Laura mentioned 4 growth centers in the state, and that's Wilmington, I'm going east to west, Wilmington, Raleigh-Durham area, Charlotte, and Asheville. And the problem is that what we saw in the fourth quarter was the Asheville drag, if you will. And so we were going like gangbusters the first 3 quarters of the year, and then the fourth quarter things really slowed down. I don't expect that slowdown to go away, frankly. The problem we have is if you look at the economic literature in catastrophes, natural disasters, what you see is 2 quarters maybe where it drags the economy down in that general area. And then for the next year after that, it's gangbusters as people rebuild, as businesses come back online. The problem here is if you look at Western North Carolina, so much of the damage was rising water, and most of the people were not insured for that. It's not like the coast where more than half the people were typically insured by rising water. Not in Western North Carolina. Who thought that was going to happen, right? So consequently, I'm a bit concerned about 2025 and the drag that the slow return, if you will, in Western NC is going to cause on the overall state's economy. Because remember, it's one of the 4 growth centers.
Travis, let's get to you and dive into the mind of the American consumer right now. What is the data that you're seeing at Visa? What are you seeing in terms of spending patterns and those other key data points that you look at in your business and that can be predictive to us all, and that is, where are consumers in their payment history? Are they keeping up to date with their payments? What's the state of things?
Yeah, so one thing that we've noticed with consumer spending over the past year is that while consumers have been growing their spending, overall consumer spending has been growing, it's been supported by fewer consumers. So what I mean by that is what we do at Visa is we have something called a spending momentum index. And what that shows is how many, it looks at how many cards are actually spending more compared to the same month last year. And what we saw consistently over 2024 was that there were fewer cards growing their spending. So we still had consumer spending growth, but it is supported by fewer cards. So that means that there was actually quite a bit more pain being hidden by the fact that some people were doing quite a bit better, right? They were spending more on their cards, they were spending more, but that they were making up for people who were pulling back on spending. And that's really what we saw. So I think in the future, though, because wage growth has remained so strong, because we still get, I mean, the last jobs report, not only was it so high, but it was actually quite broad-based compared to the jobs reports we saw previous. I mean, the most of last year, the main sectors of growth were government, healthcare, leisure, hospitality. The other ones, not so much. This last jobs report, excellent, right? So one thing we do see, so that's, so the future is still somewhat bright, even if we're probably going to, our GDP growth is going to be closer to potential than it was running hot over the last 2 years. Now, specifically on consumer spending, we're going to see a shift, not just this year, but over the next few years because of an aging population, how people are spending. We have about 12,000 people per day turning 65, right? 65 is generally the time when a lot of people will retire. Not everybody, but a lot of people, right? And so what that means is that their peak spending on specific items changes. So one of the ones that I like to show clients that it always gets a laugh is that around in the 60s, people's peak spending on wine, right? So yeah, wine tends to be the most you're going to spend on in your lifetime on wine ends up being in your 60s. Then it ends up also being, but like also, groceries, right? And then when we look at, as it goes older, it's going to be a little less fun, prescription drugs, nursing home care. All right, well, I guess it was funny too. But what is interesting is, so what I would expect to see is that we're going to see more of that. And that's actually really good news for North Carolina, particularly Raleigh-Durham, because pharmaceutical manufacturing has been such a boon to growth for this state, particularly for that area, and the demand is only going to get higher. So I expect to see that as a major source of growth, even though electronic vehicles are now becoming a bigger part of manufacturing here. I still think pharmaceuticals really is going to be a main driver of jobs and income growth for North Carolina.
So if we're drinking wine at the nursing home, we're off the charts, then,
Yeah,
right?
absolutely. You're crushing it.
So you talked about the growth in consumer spending. What role did inflationary pressure, factor into that data point that you looked at?
Right. So, I mean, the thing is that you end up getting, inflation on non-discretionary items like groceries and gas and things like that. So yeah, you'll get some boost there, but then a lot of consumers tend to pull back then on discretionary spending or restaurant spending, right? And so you do get that when you're looking nominally. But even, when we look at the government data and we adjust for inflation, overall consumer spending growth, even adjusted for inflation, has been consistently growing and growing pretty strongly. So despite high interest rates, despite high inflation, income has grown quite a bit, and people's savings have grown quite a bit, and that has actually led to quite a bit of growth in spending. And shockingly, what we saw is that's actually been broad-based in terms of wealth growth. We had such strong wealth growth from 2019, end of 2019 to 2023, that it was equivalent in terms of percentage of the growth from 2010 to 2019. So we had 40% growth in household net worth. It took us 10 years to get that. We did it in 4, right?
Yeah, if I could add one thing
Yeah,
to that.
absolutely.
One of the things when I'm out and about doing speaking engagements a data point that I put up frequently that I feel like I can't get people to believe, but it is true, is that net worths are up in every income quintile after controlling for inflation. So people are wealthier today on average than they were in 2019. Now, they don't necessarily feel that way because a lot of the inflation has occurred in things that are very proximate to people. So, for example, at the grocery store, right, you know how much eggs normally cost, and you go and they've gone up so much, and it makes you really mad because you know the price of that. Some of the places where we've seen even some deflationary pressure on things that are less proximate, so people don't necessarily pay attention how much they're spending on them. So inflation is a very real thing for people. It makes people very aggravated, so they can feel like they have less money when actually they have more. And it's really been driven by growth in incomes, but then also growth in asset values. So if you owned a home and some stocks or a Bitcoin or gold or whatever in 2019, the value of that is now higher. And so you also have this wealth effect spending that happens too. But I can't get people to necessarily believe that
well,
fact.
and I think that's what you just mentioned there is part of the reason, right? Because it's the sources of wealth between different, that are very different
Yes,
compared on
absolutely.
income spectrum. So for the lower end, the growth in wealth has really been housing.
Yeah.
So you have to, I mean, that's not nearly as liquid, right? And you don't notice it. You're not going to necessarily, especially at these rates, you're going to refinance or pull a, a HELOC or anything like that. But at the higher end, did I lose it? Okay. At the higher end, it's actually stocks, right? Financial wealth has been the main, and that's very liquid, right? You just sell your stocks, sell your bond, you're done. So that's really, I think, what the big disconnect is going on there.
Laura, let's talk about the fight against inflation, because you and I have spent a lot of time in recent years on ABC 11 having these conversations for the benefit of our audience. Where does the fight against inflation stand right now? What is it looking like going forward? Those of you who, the data that came out a month ago for November, it was 2.7% nationally. Our region was at 2.7% as well. As you and I have talked, our region historically through the inflationary period, it's been higher here in our part of the country. So where do things stand right now? What do you see as we're looking at that roadmap ahead?
Yeah, so the Fed has a target of 2% inflation, and that's core PCE if you're looking for the actual measurement over the long run. So 2.7 or 2.5, I think a lot of times people would say to me like, well, that's almost 2, but like mathematically it's not almost 2. It's come down a ton. It's come down a ton, right? Like if you look at the pace of inflation reduction over the last year and a half, I've heard my boss, Tom Barkin, say it. I've heard other Fed leaders say it. Any of them would have thought that was a big win to have inflation come down that fast. But the fight's not over yet. And the reality is that there's risk going forward of it coming back up. I mean, I think this is some of the election, and the change in leadership, some of the policies that were proposed in the election are quite inflationary potentially, and so there is some concern about that. Also, the decline in inflation has kind of tapered, and so if you look at wage pressures still being at the level they are, housing costs, as we've talked about today, shelter costs still being elevated, getting back to 2%, that is not done yet. And so I know Tom Barkin was quoted a couple weeks ago saying he kind of was in the camp of higher for longer. Other Fed leaders have been kind of saying the same thing. So, we'll see what happens going forward. The CPI report that comes out, is it this week? Maybe is tomorrow. Yeah, is really important, right? These data that come in, this is being analyzed on a regular basis. And so in my mind, there's still a lot of uncertainty going into 2025 in terms of inflation.
John, what are your thoughts on that?
We need a 30-second time out here. Yeah, the last month was 2.7 for the overall, but the core, which excludes energy and food, was 3.5, I think. 3.3, 3.5, something like that. That is definitely not close to 2.
Correct.
Okay? Second, and then the PPI came out this morning, which is the producer prices. Same type of problem. 2.7 overall, 3.5 on the core PPI. So the problem we've got here is that when you look under the hood of the CPI and the PPI, what you see that's driving the overall down is energy prices. You all buying gas now? What's it costing? Less than $3, right? Yeah. You put that in perspective to when, I know there are some people in this room that bought gas in the 60s at 30 cents a gallon. Raise your hand if you bought it at that. The $3 today, adjusted for inflation, is cheaper than that. Okay, so just bear that in mind. And it's been driving the overall CPI, overall PPI down. When you factor that out and factor out food, we've got sticky, if not boomeranging inflation. I look at 2025 and I look at two big uncertainties that could ultimately determine what's going to happen. One we all know about, and that's the new administration and what the heck they're going to do. Okay? The second one is the fact that we don't have a handle, particularly on what I call, inflationary expectations. Economists, and you've probably heard economists talk about this, there's demand pull, too much money chasing too few goods. Cost push, which is increased cost of resources, et cetera, driving prices up. But there's also a third, and that's inflationary expectations. The problem we have right now is you've all become used to what? Prices going up every time you hit the grocery store. This costs more, that costs more, whatever. We heard earlier today about the incredible increase in shelter costs. Okay? That's not going to go away anytime soon. That's not in the overall PPI or CPI. It is in the core. And so, we've got this problem that we really haven't got to the things that are causing inflation now. We got rid of a lot of the stuff from pandemic with higher interest rates. But going forward is a problem. Now, I want to talk a little bit about something else real quick. Give me about 30 seconds. All right? As a result of the fact that it's been extremely sticky, and when I say extremely sticky, I'm talking about inflation being extremely sticky for the last 6 months. We're starting to hear inflation doves start talking about, well, maybe 2%'s a bridge too far. Maybe we should start thinking about it. Intermediate term, 3%, that's all right. I'm going to give you a little example of what the difference is between 3% inflation and 2% inflation. So if you sit at 3% inflation, in 24 years, prices will be twice what they are today. If you go to the 2%, and Laura, that 2% is not what you're aiming for. It's between 0 and 2%. 2% is the top. So let's assume it's 1.5% that we get, which is what we've had for prior to this inflationary cycle. It's what we had for about 20 years. All right? If we go to 1.5%, all of a sudden that 24 years for prices to double is 50 years. I'll ask you, which one are you more comfortable with? Okay? And so I think that this fight to get these inflation pressures down and get it out of the economy once and for all is very, very important. And in my estimation, it's much more important than a soft landing.
I want to talk about interest rates in a minute, but first, let's build on something you just said there, John, with Travis, and that is this consumer worry, this anticipation of where inflation is going. How does that reflect in the data points you see and how people are using their Visa credit cards?
Well, I mean, generally, when people expect more inflation, they actually pull forward spending, right? Because they want to get ahead of the price increases. So they'll pull forward, and actually we're seeing this on the business side now because of announced tariffs, right? We're seeing a lot of people, businesses buy foreign goods, build up inventories in anticipation for higher price. Consumers are the same way. And so that's generally there's certain things that you can't pull forward, right? Like grocery spending, it's when you eat it, now you need more of it, right? But if you need that, like a new couch or that appliance, and you could either put it off or you can buy it now, they'll buy it now because they're afraid of inflation, if they can afford it, of course.
That's really interesting. That's the GDP juice based on what people are anticipating.
Yeah.
That's fascinating.
But then you give it back,
well.
by the way, though.
Yeah.
That's the thing. You give it back because eventually people run out of money to spend.
Yeah.
And then and that's the thing also with the business spending, right? Is that you're going to see in Q1 a large increase in business spending and inventory contribution to growth, and it's going to look great. Wait till Q2. Because then once we get to the second quarter and the tariffs go into effect, they're not going to be spending, and you give back that growth later.
All right, so I know all of you who are bankers and realtors in this room right now want to forecast for interest rates. Where are we going? So, Laura, let's begin with you on this. As you hear those conversations happening in the back hallways of the Fed, among your colleagues at the Fed, this consideration of 2%, or will we have some wiggle room in that? We've already obviously seen interest rates lowered, and we're not at 2%. But what do we need to be looking at? What are the components we need to be looking at as we get our own head around where interest rates may be going this year?
So there's something that many of you probably look at, which is generally called the dot plot that comes out every other FOMC meeting. And that forecast, they do forecast of the 19 FOMC participants do forecast of what they think is going to happen to GDP, inflation, employment, and interest rates, the Fed funds rate over time. And there are literal dots, if you haven't seen it. That's why it's called the dot plot. And we don't know who is who. I don't know which one Tom Barkin is. He's one of them. I don't know which one. So 12 of those dots vote. And so people look at that to kind of see what expectations are going forward. If you look at the December 2024 dot plot, it shows that the median member expects to see a couple of cuts this year, but not anywhere, not very aggressive. Compared to what some people, and it's actually less aggressive than they thought this time last year. So that rates will decline some in 2025, but less than what they thought would happen in 2025 at the end of 2023. But what is more interesting to me actually is what they think is going to happen in the longer run. So there's a longer run viewpoint, which is basically what does the federal funds rate need to be to get us to that 2% average inflation rate, core PCE over the long run, and that has been ticking up. So if you look at December 2023, the median member of the FOMC thought that rates needed to be about 2.5%, and in December 2024, the median was at 3%. That's a big jump. And if you look over time, and you can go back and see these things for the history, for years and years, and you'll see that this has been kind of slowly creeping up every cycle. They're expecting that rates will have to be higher in the longer run to get to that 2%. And some of that is because of the things we're talking about because of demographic challenges that might keep wages higher over the long run. The median person in the United States actually saw real wage decline for a period of about 30 years, and now we have seen real wage growth. And so if those pressures stay higher, if shelter costs stay higher, it will require higher interest rates to get inflation lower. So I do think that that's something that I think this is going to have longer term impacts than many people, I think, hoped.
John, interest rates are part of your specialty. What's your view of the road
Okay,
going
so
forward?
everybody in this room knows that the Fed dropped rates 3 times this fall, right? 50 points, 20, 25, 25. So overall, they dropped at 100 basis points since September. Everybody heard that. Every time the Fed reduced rates, it was on the front page of every newspaper, the lead story on every TV station, cable or otherwise, etc. How many people tracked the 10-year Treasury during that period of time, which is a market rate? What did it do, Travis, during that same 3-month period? It went up by 100 basis points.
Yeah.
Okay? That's a market-driven rate. I'm a market guy. Policy, that's over here. I'm a market-driven guy. So what we call these, by the way, when that happens, when the Fed's doing this and the market's doing this, we talk about something called bond vigilantes, who are trying to put sanity back into the market. And what they are saying, I think, is a couple of things. But mostly what they're saying is, you guys aren't done with inflation yet, okay? You're not even close to being done with inflation. I've got to be compensated on any long term. Now, some will argue that 100 basis point increase, some of that's term structure getting back to normal because we had that inverted yield curve for quite some time. But others will say it's generated by inflation. It's unclear where it is. Best case, it's 50-50, but it's probably more inflation, 70-30, than it is term structure. So that's something that concerns me because the market is basically saying you're not done with inflation. And inflation is insidious. We talked about housing earlier. I thought there was a good discussion on that, particularly as affordable housing. Just to be clear about this, inflation is the most regressive tax that we see, period, end. And we haven't got a handle on it yet. I'm obviously, you've already figured out I'm an inflationary hawk. That's why I'm still in academia and not working for the Fed like some of my classmates.
Travis, let's talk about the pressures of interest rates on consumer behavior, consumer spending. What do you see in that regard at Visa?
Yeah, so basically the main takeaway from interest rates is where you need credit most, interest rates being high will take demand away from it. So what do I mean by that? if you really think about the mortgage rates, it's interesting how little the mortgage rates have changed despite the Fed funds rate going down. It might be another thing to your
It's called
inflation.
markets.
Yeah, markets, right? There's all sorts of things with that. But what it means downstream is that things like cars, homes, things that you need credit for, because generally speaking, you don't pay all cash. Those are going to it's going to hurt demand for those. So then what goes downstream from that? Home improvement projects, appliances, the furniture, those will likely not be as strong. Now, we at Visa, our economics team, thinks that, there's going to be about 3 rate cuts this year. Maybe just 2, we're still forecasting 3. So we expect that this means that the first half of the year will be a lot fewer large purchases, but that by the time we get into the second half of the year, those interest rates coming down enough will start to spur some growth, particularly in the auto sector, particularly with the housing sector, and we're going to see more large ticket purchases. That's really what is going to be, going there. So the good news for all of you is that your card program going through the rest of the year likely will do pretty well. It's the lending part that really, I think it might not be even till 2026 till we really see a big pickup, because that's when we are likely to get mortgage rates at sub 6%.
I can feel the room perking up, the bankers and the realtors here, based on what Travis just said. That's encouraging.
Don't. Rates aren't going up. Rates aren't going down that
I
fast.
do want to say, though,
Yeah.
this discussion does highlight how insidious is a good word inflation is. It is a regressive tax. It does hit families very hard. It does cause also other things, like these things we're talking about is delaying family, like household formation. People are not moving out of their parents' homes as fast as they did before, or they're not moving out from roommates on their own. They're not getting married as early. There's not as many kids being born. There's all sorts of these other things. And the reality is, like my children's generation